like to introduce Dr. Chris Thornberg and welcome Chris up and say, please help us, big man. Serious.
Appreciate it. All right. Good. I actually got it. They got me a lavalier this year, which makes it a little easier. I can use both my hands when I'm waving around like an idiot, as the case may be. Good evening, everybody. All right, one more time. Good evening. Thank you. All right. It is wonderful to be back with PPCo to talk about, of course, what's happening in the economy. This has been a very long time. We've been doing this over a decade now. Well, like I said, it's always great to be back to tell you what's happening in the world. And, of course, happy Halloween. Boo, everybody. This year, I'm going to really scare the bejesus out of everybody. I'm going to go as Jerome Powell. That'll be my outfit for the year. Okay, let's just jump right into it, shall we? As always, by the way, we're going to have time for Q&A at the end, so hold your questions. We'll have plenty of back and forth at the very end of this presentation. The other thing, I started this last year, but worth reiterating, all the time I get requests for a copy of the presentation. At the very end of this, there will be a QR code. We will leave it up there for a while. Get your phone ready. You can take a picture of that, send an email off to Kristen, and she will get you a copy of this of course, for your own perusal. What did I said last year? Very simple. I said no recession, right? And by the way, if you notice, we haven't had a recession. Consumer spending going to remain strong. That has happened as well. Inflation is going to continue to run hot. Rates are going to continue to rise. That happened. And credit is going to start becoming tight, which is also going on. So I like to think I did a pretty good job last year. Now, I have to acknowledge what I didn't tell you last year, which we're going to talk quite a bit about this year, is the fact that two major Bay Area banks are going to fail in the next 5 or 6 months. That one I missed. I will grant you that, okay? Doesn't happen very often that I'm wrong. Therefore, we have to acknowledge it. By the way, I should tell you that's the exact opposite in my home. In my home, I'm never right. I'm always wrong. The once or twice I am right, it's worth noting. So again, it works in different directions. Tonight, what we have to talk about is what's going to happen from where we are right now. And I will tell you this. What's interesting is last year I told you not to worry. This year I'm telling you to worry a little bit more. Now, I don't think that we're going to have a recession in the next year, but I do believe that after a year of an economy expanding, it is going to start slowing, largely because of the fact that the yield curve is starting to uninvert. Unfortunately, it's uninverting the wrong way, which is to say the long end of the curve is going up, the short end of the curve is not going down. And of course, when it comes right here to the San Jose, Silicon Valley region, the reality is for all, of course, of the stories suggesting the Silicon Valley is now has been in last year's news, the reality is obviously the area remains a place that still has a bigger problem with the shortage of workers than a place with a shortage of jobs, as the case may be. And we'll get into that as well. So last year when I was here with you, we were 4 or 5 months into this next great recession prediction. And a lot of these headlines I showed you last year, all the craziness. Larry Summers is talking about the economy having a Wile E. Coyote moment. Zandy calling for yet another housing meltdown. The Conference Board, at the beginning of this year, by the way, the Conference Board put out this particular statistic, and they said that there was a 99% chance of a recession in the next 12 months. Now, I want to just start right there. First of all, how do you know a macroeconomist has a sense of humor? They use a decimal point, all right? In other words, this is not a field that invites exactitude. And anybody who tells you they have a 100% chance of anything happening in macroeconomy either is lying to you or lying to themselves. No one should have that kind of certainty, as the case may be. And of course, it brings me back to John Kenneth Galbraith, the famous old curmudgeon in economics who famously said the only function of economic forecasting is to make astrology look respectable. They used to hurt my feelings because as a forecaster, I mean, really? But about this point in time, I'm really starting to understand where this guy's coming from, right? I mean, it's absolute nonsense. Now, I get it. There's been some big news stories. We had the surge in inflation. We had the decline in consumer confidence. Of course, the Federal Reserve got on their anti-inflation crusade. They drove up the federal funds rate, and the entire curve has been going up with them. Mortgage rates right now are getting perilously close to 8%. Of course, we had the inverted yield curve. We all know that the inverted yield curve is when short-run interest rates are higher than long-run interest rates. The reason, of course, this is significant is because of the fact that the inverted yield curve is the only leading indicator, if you will, of an oncoming recession. That's our one number. That's our one statistic to hang our hat on. Now, of course, the problem with that singular statistic is that correlation is not causation. Yield curves, an inverted yield curve doesn't cause a recession. It happens to be correlated with the conditions that lead to a recession. Ergo, you can't just leap to the conclusion we're going to have a recession because the damn thing flipped. That's a mistaken way of thinking about it. And that's exactly why we never bought into this nonsense. My company, Beacon Economics, we contribute to the Wall Street Journal Economic Forecast. Every quarter when we do this, they ask us a question: what is the probability of a recession occurring within the next 12 months? The average probability was well over 60%. By the way, that's the highest it's ever been, with the exception of periods of time when we actually are in a recession. Tells you how much of a leading indicator these guys are. And we never got above 20%. And even that 20%, I got to be honest with you, I think I screwed up my spreadsheet. I meant to hit 1 and I hit 2 and I just fired it in and wasn't really paying any attention. Now, I will tell you that over the last year, not only have we not had a recession, but relative to where we were last year when I was having this conversation with you, the economy has actually been accelerating. It's not slowing down. It has been accelerating since that bit of a stall we saw in the first half of 2022. Final demand is heating up. Output is heating up. And all of this, of course, is driven on the basis of good, steady growth in consumer spending. Remember, consumer spending is 70% of GDP. The consumers are the 800-pound gorilla in the U.S. economy. And if they continue to spend, well, all the other parts of the economy may get hit by various sorts of forces, but nevertheless, we will not see a recession. In the end, if the consumers keep spending, they will pull us out of all sorts of other secondary problems. And tomorrow, today's Wednesday, tomorrow we're actually going to get the Q3 number. We don't know what that is exactly. Obviously, it gets released tomorrow morning, but we do have a preview from the Atlanta Federal Reserve. It's called the GDP Now number. And the last time I looked, the GDP Now number was suggesting we were going to have a 5% growth rate in the third quarter of the year. So yet again, accelerating even more so. They do tend to run hot. So my guess is we'll probably end up in the 4% range when the number does come out in the morning. But nevertheless, it's pretty clear we are charging towards 2024 with a big head of steam, which again is not what everybody was telling you a year ago. Now, I want to be clear. It's not just that Americans continue to spend. It's not just that Americans are surviving the scourge of high interest rates and inflation. Quite the opposite. Americans are having fun. Only thing you have to do is look at the data. Only thing you have to do is walk outside and open your eyes to realize how much fun Americans are having. Restaurant spending right now is 35% higher than it was pre-pandemic. Let me repeat that. Restaurant spending is up 35% from pre-pandemic. Nevada has never had higher gaming revenues than it has right now. And this is without a full return to the convention business. This is without the whales rolling in from China with their $100,000 chips that they put in machines that I'm never allowed to see because my net worth is nowhere near that level. Real spending on travel. Americans have been going abroad like nobody's business. Europeans are positively sick of us. If you really want to see Americans having fun, take a look at Live Nation's 10K at some point in time. It's interesting. These people are making money hand over fist. You can't throw a concert in this nation without it completely selling out, and I mean every single VIP package, as the case may be. Here's my little leading indicator for the economy. How many hours does it take you to drive from Palm Springs to LAX after Coachella ends? This year, it was 9 hours. 9 hours to go. Yes, exactly. Are Americans suffering? Hell yeah. Simple as that. Local travel, again, you can see the numbers. The airports are getting back to normal. It is interesting. You look at hotels in San Jose, they're way down. But Vegas, they're way up. Remember, consumers are doing great. Business travel has not come back. It's a separate segment. What drives San Jose? Business travel, we're all doing Zoom. That's still relatively quiet. But don't let that local condition obscure your broader standpoint from what's going on out there. Industrial production remains very high. We've had a surge in manufacturing new orders for capital goods. A lot of this had to do with the fact that the airlines are jammed. They're buying new planes like nobody's business. The Paris Air Show had a record haul of new orders. That's what's driving that particular number. Business investment is very strong. This is overall real investment comparing pre-pandemic to where we were in the second quarter. And yes, commercial health structures are down 20%, power communication down 37%, but information processing equipment up 12%, software is up 43%. And to get a better, what are you taking pictures for? Stop, QR code. You people live in Silicon Valley. You should all appreciate QR codes. What is this taking a picture thing? Take a picture of me. I'm very good, much better, right? Anyway. Look, here's the key. Tech investments, of course, continue to rise at a very slow basis. On the right-hand side, it's nominal numbers. The real numbers can get fuzzy because of how they quality control and technology. But again, just look at the data. Relative to 2014, nominal spending on software in the United States has over doubled. On other sorts of research and development, including new, has again over doubled. Lots of money flowing into technology. And you can see there's some other leading indicators. We pulled together some leading indicators. There's IT manufacturing orders. You can see how they continue to grow. Overall, unfilled orders continue to grow. Corporate profits in computer products and information, nice and solid. Again, this is an industry that remains very, very solid. And well, they should. Remember, one of the biggest problems that most employers have right now in the U.S. economy is not a lack of demand, it's a lack of people to meet that demand. We live in an era of profound labor shortages. The unemployment rate remains at about 3.7%. The job openings rate has come down a bit, but it's still running a little less than 6%. That's higher than at any point since we started measuring this data prior to the pandemic. Real wage growth has bounced back very rapidly. Real wage growth is running about 3% on a year-over-year basis. You take a look at here in San Jose, what do you see? Again, good solid growth in jobs, maybe a little bit of a slowing at the very end there, but of course the key sector, when you think about the tech sector here in Silicon Valley, San Jose tech employment, this is computer manufacturing, semiconductors, scientific research development, computer systems, again, still running nice and steady, running about 230,000 jobs. That's almost a quarter of the overall employment here in the overall region. Good solid numbers, no pullback here. And then what's interesting, the real problem yet again is the fact that as tech continues to expand and do well, because of the shortage of workers, keep in mind that the unemployment rate over here in the west side of the Bay is running an incredibly tight 3%. As a result of that, the ongoing growth and success in the tech industry weighs heavily on other parts of the economy. Admin support, wholesale trade, retail trade, all these are seeing diminished employment, mainly because they can't hire anybody. There's simply no one to hire in this ultra-tight environment. Of course, tight labor markets mean overall wages continue to rise. Average weekly wages in San Francisco and San Jose have been running about $1,800 a week. That's substantially higher than it was even a couple of years ago. Median household incomes continue to rise as well. Lots of good numbers suggesting things are great. Even housing. Mortgage rates went from 2.5% to 7.5%. And the market briefly swooned. It briefly swooned. That's all you can say. Now, I get it. Sales are still way down. Sales are hitting the same lows we saw during the middle of the Great Recession. But this is not the Great Recession. Housing starts can remain nice and steady, running about 1.45 million overall, seasonally adjusted annualized basis. Multifamily a little stronger, single family a little weaker, but good solid numbers. And housing prices briefly swooned, and now they're starting to rise again. Unbelievable the strength, even in this part of the economy, despite that enormous increase in interest rates. The local housing market, Very similar sort of picture. You could continue to see goods rising overall asking rents in the rental markets, and home prices yet again have started to bounce. Here in San Jose, for example, according to the California Association of Realtor numbers, the prices peaked a little less than 1.9 million. They dropped to about 1.5 million. You had that incredibly brief opportunity to buy an incredibly overpriced home at that cheap price before it went back to a ridiculously overpriced 1.8 million yet again for that 3-bedroom, 1.5-bath slab ranch on 1/8 of an acre. Welcome to San Jose. Enjoy yourself. It's interesting, even for all the bad news that we've been hearing in the commercial real estate sector, what are we seeing in terms of the numbers? Actually, we had a great year. If you look at overall spending in construction, in non-residential construction, the numbers bounced up substantially over the last year. And it wasn't a mix, I get that. Some places are hot, some not so much. What's really near the top there is manufacturing, but after that, of course, you still got warehouse investments up. Office investment actually has been flat. It hasn't dropped at all. So yet again, not the picture you'd expect to see given all those incredibly negative headlines. And in terms of all that manufacturing construction, well, it's all chips. Look at the chip plants going into place. Billions of dollars in new chip manufacturing plants across the United States right now, particularly there, of course, in that Phoenix area, but that is what's driving that particular show. We keep hearing about how office space is going into this, post-apocalyptic nuclear meltdown, end of the world type place. Not so much. If you actually look at the data, what you see is there's absolutely stressors in office, but at the same time you're seeing stressors in office. Industrial, which is a whole other part, is absolutely on fire. So it isn't clean what's going on out there. Yes, office is taking a big hit, but even here, take a look at the numbers. On the left-hand side is overall office vacancy rates. You can see the big increase on Class A office space rates in San Francisco. But San Jose, actually not as bad as you might think. They've come up a bit, there's no doubt about it. What's interesting though is when you think about this, two things to keep in mind. First of all, the problem in offices is not the local economy. There's a 3% unemployment rate, for God's sake. I mean, this is a very tight labor market. The real problem is, of course, that San Jose added about 45% to its office stock over the last decade. What's interesting is San Jose built all the office space, and yet it's San Francisco that seems to be taking a big hit. That's where the bigger problems are at this particular point in time. So yes, there is a reckoning to be had on the office front. Clearly, there's too much office space and not enough apartments in the Bay Area, but that is one long-run shift that you have to account for. It is not in any way, shape, or form some, if you will, indicator of the broader health of the economy. It's one sector that has to be dealt with. Even the stock market has come back over the course of the last year and a half. About the time when all these forecasters told us the economy is about to go into recession, the stock market took off. Apparently, forecasters saying we're going to have a recession is a positive indicator to the stock market. And yet again, who can blame them? That's the track record in the industry. Bank loans delinquencies remain incredibly tight, whether we're looking at bank debt or consumer debt. I mean, hell, even Bitcoin is starting to come back. Bitcoin is actually at like $27,000 right now, right? And I've said this before, there is a fundamental value to Bitcoin. It's zero. I'm not going to argue with you. It's very simple, 5 letters, Ponzi. Little Italian guy, lived about 100 years ago. Look him up, you'll figure it out, just that simple. But even here, you see, of course, Bitcoin starting to come back as the case may be. Mind you, cold comfort for this clown. Yeah, well, what are you going to do, right? Now, where does this bring me? Well, I talked about this the last couple of years, but I think it's worth, yet again, diving into this, that there is a distinct gap between social narratives and economic realities. And that's been something that's taken me a little time and effort to internalize. In my world, the Chicago School of Thought, we were trained right from the get-go to believe in the idea of the rational agent. And the rational agent internalizes information and makes the best decision they can. In the Chicago School of Thought, in that particular world, the economic reality and the social narratives are highly aligned. But the only thing you have to do is take a step back from that assumption and actually look at the data and read the newspaper and recognize that that is not the case. There is, in fact, a distinct gap between social narratives and economic realities. And this is something we all have to take into account. Now, what exactly do I mean by this? Well, take, for example, the positive value of Bitcoin, right? Why? Why does this thing that clearly has no value, nevertheless, have a substantial value when we see being traded on the various sorts of platforms it can be traded on? Well, that's a function of social narratives. The economic reality says, look, this thing has no value. But nevertheless, a bunch of crypto bros have convinced themselves with a bunch of gobbledygook that this is the real deal. It's going to take over this, it's going to take over that. And as a result of that, you've suddenly created positive value out of thin air. Only a social narrative can have that kind of impact. Now, there's another type of way of looking at this too, which is economic realities that are not part of the social narrative. A clear case of that is our federal budget deficit. We have a $1.7 trillion budget deficit, which, by the way, is about to go to $1.8 billion because they want to borrow $100 billion to lob a bunch of weapons at Ukraine and Israel. We have 120% debt to GDP, and we have enormous obligations driven by our, of course, commitments to Medicare and Social Security. We have an enormous problem on our hand, and nobody's talking about it. I mean, don't get me wrong, we talk about it, but we don't really talk about it. It's not part of the election conversation. No one's really thinking of this in any real way. It's just something you kind of mention and then you move on. It's not part of our social narrative, which is why nobody in Washington, D.C. is taking this seriously. And they aren't. Look, I get it. If you're a Republican, you want to talk all about how those Democrats want to take it from $1.7 trillion and raise it to $1.9 trillion. Here's the problem. The Republicans want to take it from $1.7 trillion and lower it to $1.6 trillion. See, nobody's really having a concrete conversation about this because it's not part of our narrative. Now, there is the place in between. For example, what's in between? Well, look, we all know Ticketmaster is completely ripping us off. It's part of the social narrative. It's clear economic reality. These guys have a monopoly. Here, of course, the issue is, what the hell do we do about it, right? Again, there's a whole other problem, as the case may be. But yet again, you have to keep this in mind. And when you realize this, you see narratives skewing interpretations of economic news, narratives at the root of economic bubbles, narratives driving bad public policies. This is why a couple of years ago, Robert Shiller wrote this wonderful book, Narrative Economics, and he said, we need to incorporate the contagion of narratives in economic theory, otherwise we remain blind to a really, very real force for economic change. He is 100% right. If you want to be a good forecaster, you have to look at the data, and then you have to look at the story. And you have to keep in mind these could be two different things. And you have to put them together to try and figure out what the hell is going to happen next. It's complicated, but this is what you really have to do. And, you know, there's a big question, why? Why do people so readily believe crazy stuff? Well, another great book, Daniel Kahneman wrote a book called Thinking Fast and Slow a few years ago, completely seminal. Let me give you some idea of the impact of Daniel Kahneman. Daniel Kahneman is a psychologist. He's an academic psychologist who won the Nobel Prize in economics because of his enormously powerful contribution to understanding how people make economic decisions. And what he says in this book, to simplify it, is very simple. We have two ways of thinking, type 1 and type 2. Type 2, that's our rational side. That's the side that allows us to come up with these incredibly complex microchips and figure out quantum mechanics and the origin of the universe and how to fight cancer. This is that side of the brain. It is our rational, logical thought. But the thing here we all have to recognize is that the type 2 system, as powerful as it is, well, it's also an expensive system. It's exhausting. We don't have that much bandwidth. Let's face it, folks, we're all 286 chips in a Pentium world, okay? It's as simple as that, and no one under 40 has any idea what that joke means. But what this boils down to is very simple, and is we have to rely on our type 1 system more often than we like to think. And your type 1 system, that's your lizard brain. That's the instantaneous thing. That gets you out of the way of a rampaging dinosaur and makes your mouth water when you see a really nice dessert. This is your type 1 brain, right? And what he says is very simple. System 1 is gullible and biased to believe. System 2 is in charge of doubting and unbelieving. The problem is System 2 is sometimes busy and often lazy. And we all know that. You just sit down and try to do your tax. This is why you have these guys, right? If you try to do your own taxes, 3 hours, you have no idea what's going on. You feel like you just ran a marathon, right? This is your type 1 system simply running out of energy. Now, here's the issue with System 1. Again, it's gullible, it's biased, it's quick, it's too quick. And you can go through a litany of ways that the type 1 system can be fooled by the world around it. They call them cognitive biases. And there's more of these than I could possibly shake a stick at. But let me give you a little example of a cognitive bias, one that I find very simple to understand. And we've all seen these before. They're called optical illusions, right? For example, are the horizontal lines in this picture parallel? Ed, what do you think? No? Ed's type 2 system is already turned off. He's already in pure type 1. I love it. Thank you, Ed, for being honest about where you are. This is a couple glasses of wine in. Anybody using their type 2 system would recognize that, of course, these are parallel. Of course they are. I wouldn't have asked the question otherwise. That is your type 2 system thinking about it.
I was being your go-to guy.
Well, there you go. I appreciate it. You were great. Great. Yes, those lines are, in fact, parallel. But if you turn off your type 2 system just for a second, do they look parallel? Of course not. That's a cognitive bias. It is your brain telling you something that isn't true on the basis of the architecture that runs our systems and how we interpret the world around it. Same thing here. Is this a GIF? Is it moving? No. It's just an optical illusion. It's a cognitive bias. And our cognitive biases hit us in all sorts of different ways. It's just as simple. And that brings me, of course, to one of my favorite quotes of all time. It ain't what you don't know that gets you into trouble. It's what you know for sure that ain't so. This, of course, is exactly the last thing that happened to that guy when his Tesla went underneath the truck. Anyway, putting that to one side. Now, there's all sorts of famous false narratives, right? We know this. All sorts of famous false narratives, stories we know aren't true, but somehow or other remain in the common lexicon. For example, JFK was assassinated by the CIA. We've all heard this lots, right? Or Area 51 is full of aliens and government agents. That's another big narrative that's been around us for a while. Elvis lives, right? We know he's out there. Inflation is far worse than the official statistics. I hear it all the time. I think I've heard that question here a few times. But again, this is a cognitive bias. If you see something that's priced the way you expect, you don't think about it. If you see something and it turns out to be more expensive than you expect, you remember it. Ergo, you have a biased memory. It is a cognitive bias. But for Prop 13, this state will be overrun with homeless grandparents. Again, absolutely preposterous. There's not one other state with Prop 13, and yet they're not overrun with homeless old people. Clearly, total nonsense. Yet every time we talk about doing something about Prop 13, you have, of course, the Howard Jarvis Foundation roll out this same old nonsensical narrative, and lo and behold, we all vote it down because we don't want grandma to be homeless, do we now? How about raising the minimum wage as a surefire way to reduce poverty? Again, over and over, this state loves that narrative. Here's the problem with it. There is no relationship, there is zero relationship between minimum wages and poverty rates. Doesn't exist. Doesn't actually help. It's a ridiculous policy that doesn't really fix anything. How about California is built out, doesn't have any more space for new housing? I hear this all the time, particularly from people who live in San Mateo. We don't have room for housing. We're all built out. What? Really? Really? Hey, I was just in Japan. I don't know if anybody's been to Osaka. Osaka is 19 million people built in a city roughly the size of Torrance, as far as I could tell, okay? I'm sorry, that's a Southern California city. Mountain View, how about Mountain View? It's roughly the size of Mountain View. Does that make sense? And what are you talking about? We have lots of space in this particular state. Or, of course, Travis Kelce and Taylor Swift are dating just as a PR stunt. Give me a break. I know true love when I see it, people. I do. Or the AI narrative, right? This is like the most ridiculous thing. AI is coming to steal your job. Millions of jobs are going to be lost to AI. You know what the reality of AI is? Well, this is where all the crypto bros are going next, people, okay? Yeah. It's the next big bubble. Watch out for it. Simple as that. Now, of course, how we got to this ridiculous place we're in right now all boils down to bizarre narratives. In this case, of course, the bizarre narratives regarding what the pandemic meant for the U.S. economy. Now, I get it. The pandemic was a tragic time. Millions of people passed. We were stuck inside for a year. It was scary. It was uncertain. I agree with all of that. What I don't agree with, what the hell happened there? That was weird. I got some weird graphics mix up here. Apologies for that, but I'll deal with it later. Anyway, the point here, of course, is the pandemic didn't mean that much for the U.S. economy. Yes, it was a scary time, but it wasn't going to cause a Great Depression. It wasn't going to cause a 10-year hit to our labor markets. This was all completely nonsensical. And to give you some concept of just how different it was, just take a look at overall GDP relative to what we call potential GDP. This is the output gap, which is a good way of thinking about recessions. The pandemic recession was the deepest recession we've ever seen. The U.S. economy contracted by 10% from Q1 to Q2. 10%. We've never seen anything like that before. But keep something in mind. It was the deepest recession ever. It was also the shortest. It was over in about 8 weeks. By the third quarter of that particular year, the economy was rocketing back. And within a year, we were back to normal levels of economic output. So a year and 1 quarter from beginning to end. Contrast that to the Great Recession. That was 6 quarters down. 6 quarters from peak to trough, and then 7 years for full recovery. It was almost a 9-year business cycle. So yeah, I get it. It was scary, it was crazy, but it was here and it was yesterday. It was history like that. But don't let reality intrude on, of course, a good narrative. Washington, D.C. loved the idea that this was the end of the world, that they were going to ride to a rescue. The actual lost GDP from the pandemic, $1.2 trillion. In return for our troubles, for being stuck inside for a year, we had $6 trillion of fiscal stimulus lobbed at this economy. That is $5 of stimulus for every dollar of lost income. Or to put that in context, that is a $50,000 check for every single household in the United States. That's what we got in return for the pandemic, a $50,000 check. Now, when you think about that, you start to recognize that a lot of what's been happening is driven by nothing more than that excessive stimulus. Now, one of the big questions, where do they get the cash from? They couldn't have gone to the bond markets. You know, the bond market, all debt levels in the United States expanded by a little over $3 trillion in 2019. Had Congress had to go to the bond markets and borrow $3 trillion in 2020 and $3 trillion more in 2021, there just wasn't enough money. Mortgage rates, 10-year bond rates would have gone to about 38%, and they never would have sold all the treasuries anyway. Never would have happened. Never could have financed that. Was not possible. They didn't have to go to the bond markets. They rolled down to the street to the formerly independent institution called the Federal Reserve. Now, back in the day, when Alan Greenspan was there, had Congress show up and said, we need money, he would have said, why? But now, of course, we have a politician leading that. His name is Jerome Powell. And when they showed up and said, we need money, he said, how much? And in the end, they settled on $5 trillion. $5 trillion in brand new cash given to Congress through the vehicle known as quantitative easing. Now remember, quantitative easing is no different than printing money. We just have a little mechanism for it. We print the money and then we buy treasuries. That's the back sort of office operations there. It's no different than Jerome Powell printing up $5 trillion, throwing it in a suitcase, walking down to Congress and saying, here you go, kids, have fun, try not to spend it all in one place. $5 trillion. Now, this is not the first time we've used this particular tool. Ben Bernanke famously used it, back, of course, in the wake of the Great Recession. But we have to understand that tools need to be used for a specific reason. Why did Ben Bernanke use it? Because Ben Bernanke was facing a real depression. What causes a depression? It's not a pandemic. What causes a depression is a combination of two things: a bad recession combined with the scourge of deflation. That is to say, when prices want to fall, typically is driven by a contracting money supply. We've seen it over and over and over. You combine those two things, a bad recession with a monetary contraction, and you are in for a world of hurt. That's exactly what Ben Bernanke was facing. We had, of course, an enormous recession on our hand because of the collapse in the housing market and collapse in consumer spending. But we also had deflation because of the collapse of the subprime bubble and problem that it created for the financial system. Ben Bernanke had to offset that by expanding the money supply. He decided to do it through quantitative easing. $3.5 trillion of quantitative easing strategically deployed over 6 years to keep money supply growth nice and steady. This time around, this guy, Jerome Powell, let's be clear. He did $5 trillion, almost 50% more, and he didn't do it over 6 years. He did it over lunch. And he did it in April of 2020 without a hint of what was actually going to happen. You could not have asked for a more insane use of Federal Reserve policy powers than what he deployed at that particular point in time. And of course, because there was no financial crisis, what he did set off one of the largest expansions of money supply we've ever seen. Now, what happens when you have too much excess money? Well, of course, we had Milton Friedman many years ago told us all about this, explained it to us in a book called Money Mischief, which should be there on the right-hand side, and for some reason it's not. But of course, in the short term, we end up with money illusion. Everybody got $50,000 check. Hey, we feel rich. Well, what do you do when you're rich? You invest and you spend. By spending, the economy takes off. By investing, interest rates drop, asset prices go up. Everything feels great. The problem here is it is an illusion. It is not real. It is nothing more than, of course, the function of feeling this way, even though you're not. Because in the end, real wealth is driven not by the quantity of currency floating around an economy, but the actual ability to produce goods and services. And that's a function of labor and skills and infrastructure and institutions and technology and a functioning credit market and all that kind of good stuff. None of that is changed by lobbing $50,000 in brand new printed cash in every household. You don't change a thing. All you've done is push demand beyond the ability for the economy to meet that demand. When there's more demand than there is supply, what happens to prices? It goes up. What happens to all prices? They all go up. And we call that, of course, inflation. Inflation kicks in theory, asset prices start to sag back, interest rates start to go up, spending subsides back to normal. Does it cause a recession? No. We've never had an inflation-driven recession before. That hasn't happened in U.S. economic history. Now, mind you, it can create other sorts of issues. It makes us more susceptible to a recession. For example, the oil shock in the mid-'70s was much worse than it would have been, largely, of course, because of the fact that in the mid-'70s we were in the midst of a big inflation surge. Or you can think about, of course, the recession we had in the beginning of the 1980s. But yet again, that wasn't caused by inflation. That was caused by the cure for inflation, which yet again, something we all have to keep in our minds. So why not do it then? Why not do it? Well, of course, the issue there is long-run consequences. What are the long-run consequences of inflation? Well, first of all, there are winners and losers. When you're lobbing $5 trillion at the economy, the winners are the people who get the money and the losers are those who don't. And when you have winners and losers, you create political turmoil. Obviously, financial risks increase. It's harder to invest. It's harder to save in this kind of atmosphere. And that means real investment goes down, and that's bad for an economy in the long run. And of course, on top of everything else, as already noted, you also have an economy that is brittle, and that's something we all have to worry about as well. Now, how it actually operates is through the wealth mechanism. That is to say, you throw all this money at the economy. It actually just wasn't $50,000. Let me explain how this worked. $5 trillion of brand new money set off an enormous surge in asset prices, which fed back and made people feel even richer. That $5 trillion in initial cash thrown at the economy caused overall household net worth to go up by $37 trillion. He got a 7-to-1 return on that initial investment. That, by the way, is about a 28% increase in household net worth. Now, this is not the first bubble we've had in net worth. We had one in the late 90s, that was .com. We had one in the middle of the first decade of this century, that was subprime. And now we have Jerome's quantitative easing version of this. Why is this one different than the last two? Well, the first one was just equity. And that, of course, is the game of rich people. It didn't really have any real impact on the bottom 90%. The second one, the subprime, did have an impact on our economy, but that was particularly bad for low-income families, for low net worth families, because they're the ones who got the subprime loans and got foreclosed on. But just the pure cash version of this, well, that was particularly good for the bottom 50%, and that's one of the reasons why this turned into so much consumer demand, ergo so much inflation, so rapidly. You can see on the right-hand side, this is index real net worth, and you can see how the bottom 50% has benefited tremendously from this, and then again, it explains why so much of this turned into spending quickly. Ultimately, inflation is caused by too much money chasing too few goods. Inflation is being caused by excessive demand. You have to keep that in mind. Now, no one is, right? We hear all the time how inflation is hurting consumers. We hear that constantly. And it's so funny because it's not how it works. Just take for a second gasoline, right? In the beginning of 2022, you saw gasoline prices go up 50% in about 5 months. And the hand-wringing and the pearl-clutching you saw in the papers over this increase in gasoline prices was unbelievable. Oh my God, people won't be able to feed their children. They won't be able to take prescription medications because of gasoline prices. Ah! We saw this, right? But let's be clear. 50% increase in gasoline prices, I get it. If this was really just a big supply shock, Putin invaded Ukraine, not enough oil, suddenly supply shifts back, prices go up. If this was really all about hurting consumers, if it's just supply curve, what happens to the quantity of gasoline consumed? It goes down, right? So 50% increase, there's got to be a substantial decline, right? Well, actually, gasoline went down about 1.5%. So think of that. A 50% increase in prices, and we see a 1.5% decline in consumer spending on gasoline. When you see that little reaction, that tells you everything you need to know. This isn't supply, it's all about demand. And you probably also remember this television news story. And this is the stuff that makes me crazy. This is why I can't even watch the news. They walk up to this guy in the gas station, and they shove a camera in his face. And what do they ask him? Hey, man, how do you feel about filling up your tank? How do you feel about it? No, really, what do you feel? Well, he expected to pay $90 to fill up his tank, and instead he paid $120. I don't care if you're in poverty or you're a multimillionaire. You're annoyed, period. It did not meet your expectation, and that is annoying. And that's the response you're going to get. Yeah, I'm not happy about this. Who are you mad at? I don't know, Saudi Arabia. I'm mad at Putin. I'm mad at Biden. I'll figure out someone to blame, right? But again, that's a dumb question. How do you feel? How do you feel? The real question is, where are you going? And if the answer is we're taking the new boat down to the lake to do a little fishing, clearly you don't care about gas prices. Well, yeah, I do. Yeah, I do. Why? Well, you had to buy the cheap beer. Well, that's okay. Gavin's got you covered, right? You got your inflation check. Think of it. What's the problem? Why do we have inflation? Because people have too much money to spend. What's our solution? Give them more money. What are we doing? What are we doing? Wow. That's got all screwed up. All right, let's get rid of this. Look, it wasn't all that big of a deal. Some of my graphics got mixed up in the presentation, and I apologize for that, which is too bad because that was a good punchline there. But look, it's better to have this punchline to lead into this graph. Let me explain what this graph just says, and we'll go from there. To be clear, this really isn't even all that bad of a surge in inflation. Take a look on the left-hand side here. This is a 5-year cumulative change in prices in the United States. And over the last 5 years, we've seen about an 18% increase in prices. That's it. That's about the same as we saw in the run-up to the Great Recession. So this really isn't all that big of a surge. If you really want to see inflation in its full gory force, go back to 1979, where after 5 years it was a 50% increase in prices. That's inflation. Not what we're experiencing right now. This really isn't that big a case. And of course, for all the comments about inflation, the offsetting effect of this is that anybody can get a job and get well paid for it. Look how tight these labor markets are. In tight labor markets right now, we have about 1.5 job openings for every person looking for a job in the United States. Why do we have labor shortages? No, it's not because people are staying at home spending their stimulus checks. This all goes back to narratives versus reality. For 30 years, demographers have been giving the United States a basic reality. They've been saying, we're not having enough kids, we're going to run out of workers. Right? Simple as that. The problem is it never got into our social narrative, at least not to the point where we thought that it was important to do anything about it. So as a result of that, even before the pandemic, you saw the signs of a labor shortage really starting to hit the economy. And of course, it's more profound than ever before because over the course of the pandemic, a couple million people decided to retire. Now, the upside, of course, of tight labor markets is it's very good for workers, particularly low-skilled workers. Since about 2015, workers in the bottom 50% of earnings have seen greater earnings growth than those in the top 50% of earnings. That is true. Since 2015, we've been seeing declining income inequality in the United States. And that is particularly true since the beginning of the pandemic. The dark line there are people in the bottom half of the distribution. The orange line is the top half. And look how the top half took a big hit to their earnings over the course of the pandemic. The bottom never saw actual real declines in their income, even when you're inflation adjusting. Now, that's great for those folks, and it's nice to see income inequality coming down. The other part of it, of course, is trying to run a business that uses low-skilled workers. Hotels have seen the cost of their workforce going up by 34% in 3 years. Childcare, 29%. Food and drink, 26%. This is why your standard restaurant is not real happy about that 35% increase in revenues. It doesn't matter. It's all going to my workers and my food costs. For them, they're running faster than ever just to stay still. And I appreciate that. But at least they have that front-end demand that's keeping the show going, as the case may be. How about earnings by age? Are younger workers falling behind? We hear that all the time in terms of that stuff. Millennials will have a worse standard of living than their parents, right? This is not one of those narratives that stick with us. Well, just take a look. You can see real earnings at every age level continue to rise. This is a great way of looking at it. This is cohort comparison of real earnings. These are inflation adjusted. So in 2022, a 25 to 34-year-old was making a median income of $46,000. Well, back in 2002, where today's 45 to 54-year-olds, when these folks were 25 to 34, well, they were making $49,000. So a little bit of a diminishment, but not all that much. On the other hand, if you go way over here talking about boomers, well, if you go back to 1992 when 55 to 64 years were around, they were making $32,000. So not only is your average Gen Z doing better, not only are they doing as well as their parents, they're doing better than their parents. Because their parents, when they were their age, weren't making anywhere near that money. That, again, is a complete falsehood. It's not true. And it isn't just that. I'm amazed how often we continue to talk about how Gen Z or millennials are going to have a worse standard of living. Really? How about the fact that all the things that don't show up in the numbers? The fact that life expectancy is higher now than when I was, 25 years old. Infant mortality is way down. Crime rate, particularly violent crime rate, is down. A percent of the population with a college degree is higher. None of these are in the statistics, and I would argue all these things improve the quality of life. I mean, what else is different now from when I was a kid? Well, this is a cell phone today. This is what a cell phone looked like when I was a kid, right? Or you got a car today, right? Fancy electric. This is a car when I was a kid. Do you remember these things? They used to blow up if you ran into the back of them. I think I had one of these. Here's a TV when I was a kid. Here's a TV today. That's a little bit different as the case may be. And by the way, nowadays, as opposed to having 4 channels, you got 10,000 streaming services to watch 1 million hours of entertainment. Really? I mean, this is how much better lives are today for young people. This is what we used to have to do for dieting. Now we just take a damn shot. Really? Really? And people complain, oh, life is so terrible today. Well, that's fine. Maybe all those things are true, but we'll never be able to afford a home. We've all seen this meme, right? And you always got this guy, this is one of those Gen Zs or millennials over there, explaining to you explaining, you boomer, you have no idea. Back in the 1980s, a home price was $80,000. Down payment was $16,000. Salary was $30,000. Down payment was half a year's salary. Today it's $400,000, $80,000, $50,000. Today your down payment is a year and a half. Don't you get it, boomer? Don't you understand how hard it is for us? Now, a couple of things here to keep in mind. First of all, those numbers are kind of wrong. Actually, they're a lot wrong. Turns out income wasn't that low then, it's higher now. Home prices were about the same, but they're lower today. And when you add that all up, it turns out that the down payment goes from 64% to 97%. But this isn't even the real difference. Does anybody else want to know what the difference is between today and 1983, 84? Any of you gray hairs out there? You want to tell me what the difference was? Yes? Oh, you would like to know. All right, well, the answer is interest rates, which are like nothing compared to what they were back then. And once you throw that in, turns out housing really isn't unaffordable. This is one of the silliest narratives our nation has ever been beset with. I can't afford to buy you a home. Yes, you can. In fact, it's more affordable now than it was when I was a kid. Simple as that. Here's the key. It was never easy to buy a home. That's the key. This idea, this story that everybody owned a home in 1968, complete lie. The world didn't work that way back then. I don't know why we think these things. On top of everything else, does anybody else know the house on the right is a hell of a lot nicer than the house on the left? It's got a garage, it's got a second story, it doesn't have those ugly little costly things on the front stoop. What are those called? Kids. None of those kid things. We don't need those floating around, as the case may be. It's unbelievable. Now, don't get me wrong. Affordability has gotten very bad in the last year because, of course, the huge increase in interest rates. But this is affordability looking at interest payments relative to incomes. And yes, you see a spike from a decade of the best affordability for housing we have ever seen to something that's a little less affordable. Sorry, millennials, if you didn't buy a house from here to here, that's on you, not on me, okay? You screwed up, you missed your opportunity. But yes, it's not very affordable right now. Why? Well, it's not very affordable because of the craziness of the last 3 years. Think about the insanity of what happened in the housing market when, of course, the Federal Reserve dumped all that money on the economy. The housing market went nuts. From July 20 to July 2022, Tampa, home prices went up 64%, 2 years. Phoenix, 62%. Miami, 61%. Dallas, 54%. What's weird is you have to get down to San Diego before you see one California entry. Usually we're way out in front. Who's ever heard of Dallas home prices growing faster than ours? But that's exactly what happened. So they threw all the money at the economy. This asset market absolutely exploded. And then interest rates went from 5%, they went down to 2.5%, and they shot up to 7.5%. And boy, did that party come to an end really quickly. Of course it did. Affordability just got really bad very quickly. Here's the key. The market hasn't capitulated. Interest rates went up, but if you sat down and I ran my basic financial spreadsheet, where are my wealth guys over? Where did you guys go? You're way back there. These guys can show you how all that works. You run down, sit that down. And in a basic, efficient market world, interest rates go up and home prices come down. We don't live in that world. We live in a world where what people are willing to sell house for is what that number is in their head. And they don't give a crap about your spreadsheet. On top of everything else, let's be clear. If I'm going to move out of this house, I'm going to walk away from my 2.75% 30-year fixed rate mortgage and go to a 7.75% 30-year fixed rate mortgage. And the only way I'm going to do that is if you pay me a sufficient amount for this particular house. So as a result of that, prices haven't fallen. The fundamentals are too good. $30 trillion of home equity, lowest debt equity ratios you've ever seen, incredibly clean markets, and absolutely no vacancy rates because we've seen a decade of incredibly weak housing production. This is not a housing market that's going to fall apart by any stretch of the imagination. This is a housing market that is going to do exactly what you'd expect. A big decline in sales, and then it just sits there. People say, is this a good time to buy a home? No, it's not. It's a terrible time to buy a home. There's no way I would buy a house right now because it's very, very expensive once you count the cost of debt. If you're buying a house because you think you're going to make a good return on it, this is not where you want to put your money. If you're buying a house because you're 3 months away from having your first child, buy the house Because in the end, a house is not just an investment decision. It's also a lifestyle choice. And at some points in time, you just have to suck it up and take the hit. But housing is overpriced, and the result of this is a market that's going to be flat for a while, simply because of the fact that prices are not going to fall to where they should be. The other side of it is the lack of supply means we continue to see good, solid housing starts, running 1.4 million per year, which is better than we were from at any point between 2009 and 2018. So we actually still have activity, and that part of the market is still working well. How about in California? Where are we at this particular point in time? Again, all these narratives we've seen about the economy, worst place for doing business. That's like 15 years in a row, according to the Chief Executive magazine. We've been the worst place to do business. Corporations are leaving. Our economy is falling apart. How about Elon Musk? So many short stuttered in downtown San Francisco. Feels post-apocalyptic. Or you have, of course, new data that says 34% of downtown San Francisco office space is empty, or crime concerns in Oakland. Boy, if you didn't live here, you'd swear to God this place was on par with Escape from New York, like Part 2, or Escape from San Francisco. You just ready to see Kurt Russell coming out of the woodwork. And it just, what is going on? Now, I've already showed you some of the basic data. There's a 3% unemployment rate. Jobs are great. The problem is a lack of workers. None of this matches, of course, that particular narrative. What is going on? Well, the state has come back. It's done quite well. Yes, we recovered a little slower than everybody else, but right now we're about the 17th fastest growing state. We're at 3.8% from where we were pre-pandemic. You're right. We're nowhere near Texas, Florida, or Nevada, but we're way above the other 2/3 of space. And of course, remember, when you talk about a lack of job growth, it isn't a function of labor demand, it is a function of labor supply. Whether you're looking at job openings, the unemployment rate, what you see is an economy that is lacking workers. And when you ask why we're lacking workers, go back to the conversation about the big decline in overall labor force growth, which has been particularly profound here in California as a result, of course, of our unwillingness to build housing. We do stand out that way. In fact, it's interesting. If you think about where we are over the course of the last 20 years, California is not the worst place for labor force growth. We're still above Mississippi, Wyoming, Maine, and Vermont. Not that I think that those are our peer group, as the case may be, but obviously we're way below Idaho, Arizona, Colorado, and Texas. Again, what is it? Texas versus California? One thing only. Housing permits. They build housing, we don't. They have population growth, we don't. People move to Texas, they move out of California. Simple as that. It's not complicated. The only question is, if we want to compete with Texas, we have to build more housing. Are we willing to do that? And so far, the answer has been no, not really. Not really. In fact, what's interesting is you actually take a look at the number, Texas is becoming more like us. NIMBYism is suddenly a thing in Texas. Suddenly, it's hard to build. This is why prices in Dallas are actually growing faster than they are in California. They're adopting our strategies rather than the other way around. Now, the bigger issue, of course, now, in the last couple of years, is suddenly we've turned a corner. Because, yes, we haven't had labor force growth, but now the labor force is topped out, and even worse news comes when we start looking at population. Because one of the things you've seen over the course of the last couple of years is the population in California is actually starting to fall. And this becomes scary. And yet again, what's the narrative? The narrative is people are fleeing California. They are fleeing. They are fleeing high housing costs. They're fleeing bad regulations. They're fleeing high taxes. They're fleeing homelessness. They're fleeing. And I always love that term, that verb, fleeing. Now, if people were truly fleeing, what would happen to housing vacancy rates? It would go up. Well, there it is on the left-hand side. California's housing vacancy rate has never been lower than it is right now. So no, people aren't fleeing. You cannot have record-tight labor markets, record low levels of vacancy rates, and say people are fleeing. They're not fleeing, they're being pushed out. Now, if you look across California, it's a very similar sort of picture. Who's grown and who hasn't? Well, it's a function of who has labor force and who doesn't. Top of the list, Stockton. Stockton has seen 10% job growth from before the pandemic. 10%. After that, Sacramento, Inland Empire, Fresno, Bakersfield. It's not till you get to San Diego where you see a major coastal economy, and then you get into San Jose. And then down there you see Oakland, Ventura, Los Angeles, Santa Rosa. Why are all these places struggling to add jobs? Because their labor forces are contracting. No workers, no job filling. Simple as that. So what is going on here? There's something a little weird, because I'm talking about population declines, and yet I'm also talking about about housing scarcity. How do those two things fit together? Well, yet again, if you take a look at the data here in Santa Clara County, you can see net migration out. You can see falling number of population. We know that there's a lot of homelessness. How do you put this all together? Well, see, this is, again, the importance of getting the narrative right. Homelessness. Why do we have a homelessness crisis? The story in Sacramento is very clear. We have a homelessness crisis because renters are doing bad. Renters are getting crushed by inflation. Rents are growing faster than renter incomes. These people are stressed to the max. They have to forego medications. They can't feed themselves. One paycheck and they're homeless. Ergo, we need rent control, eviction moratoriums, affordable housing mandates to save the renter. Problem with that story is it's completely wrong. In fact, if you take a look at anything like renter incomes, you find a completely different story. Renter incomes are growing up faster than owner incomes. So what's going on? Well, here's the issue. Yes, you have declining population in the Bay Area, but take a look at Santa Clara and Alameda households. They're not shrinking, they're growing. You have fewer people and more households, which, by the way, can only occur if there's a big decline in people per household. Here's your story. Here is your story. A decline in people per household. Why? Well, again, let's go through the 3 worst things you can possibly live with. Bed bugs, cockroaches, and roommates. Bed bugs and cockroaches, hard to get rid of. Roommates, you can get rid of them. You move to your own place. This is the key. Renters are doing so well, they're spreading out. They're not living with their parents. They're not living with roommates. They're spreading out. Ergo, we have a decline in people per household. This is why you have rising homelessness. Consider, there has been a 7.5% decline in people per household in Santa Clara County in a decade. That means in a decade, if you didn't expand your housing stock by 7.5%, you have a problem. And the problem is people get pushed out. They get pushed out of the county, they get pushed out of the state, or they get pushed into the street. Homelessness is a function of the prosperity of California renters, not because they're doing poorly. And when you realize that, you realize rent control makes it worse. Affordable housing mandates don't help. Eviction moratoriums make the problem worse. You're making the situation worse, not better. The only way you can get yourself out of this particular hold is to build, build, build. And that's the one thing we are simply not doing. Median rent as a percent of household income has been falling in Santa Clara despite the huge increases in rents. And you look at permits, they're still not growing very well. You need a lot more housing, a lot more density. That is the key. Simple as that. Simple as that. Now, where do we go from here? Well, let's talk about 2 things. First of all, let's talk about the consumer. I already said that. Consumer's 70% of the economy. How's the consumer doing? Are they going to run out of steam? Every day we get that story, right? Any minute now, they're going to run out of money. Any minute, all that money they got given, they're going to run out. Well, again, complete nonsense. First of all, tight labor markets, the fact that inflation is slowing means real disposable income starting to rise. But perhaps more importantly, one of the things I told you earlier is when inflation kicks in, you typically have some degree of capitulation in asset prices. Not this time. We live in a very odd world where asset prices went up and they stayed up. And as a result of that, we had a little bit of a swoon in net worth, but it's already come back. Americans are still sitting on piles and piles of cash relative to where they were pre-pandemic. Here's my favorite number. Household checkable deposits, cash on hand. From 2014 to 2020, Americans were hanging on to about $1 trillion cash liquidity. That's money in your checking account, money in your savings account. $1 trillion cash liquidity. Right now, $4 trillion cash liquidity. This is as of Q2 of this particular year. 4 times what it was prior to the pandemic. 4 times. And yet, as I already told you, most of that money is sitting, most of the growth has gone into the bottom 50%, where it really quickly turns into consumer demand. The consumer will remain aligned and well. They're going to continue to move. And by the way, behind all that wealth is a whole other afterburner called debt. Now, we're just seeing a little bit of this right now. You're starting to see a pickup in people using credit card debt. And you're starting to see a pickup in people using HELOC. But remember, credit cards and HELOC are ways of extracting some of that wealth from your asset portfolio. Overall, they can afford it. Overall, delinquency rates in consumer debt's very, very low. Could this turn into something problematic in a year, 2 years, 3 years, 4 years? Sure, it could. But right now, it just means that there's even more things to continue to help that consumer move forward. Consumers are going to be fine. They're not the issues you got to face. Again, these things are getting all messed up. But my pictures are all messed up. We'll get a better thing. The real scary thing, of course, is the inflation narrative. And I talked a little about this last time. Why do we have inflation? Why? Well, you've heard all sorts of folks from folks in D.C. Oh, we have inflation because of supply chain issues, because of the federal deficit, because of corporate greed. That's Liz Warren. Not enough manufacturing jobs. That's our president has told us that. Low interest rates. That's Mohammed Al-Aryan, who is considered to be some investment genius. Or inflation expectations. I like this. Inflation expectation. Why do we have inflation? Because people expect inflation. Well, it's pretty dumb, isn't it? Like, what does that even mean? It's completely empty. Who would possibly think, oh, that guy? Yes. Our federal chair believes if the public expects inflation to remain low and stable over time, then absent major shocks, it will. Unfortunately, the same is true of high expectations of high and volatile inflation. Our federal chairman believes something as intrinsically empty, intellectually stupid, as the idea that inflation drives inflation. It's like saying, oh, inflation is caused by the price of Swift concert tickets or by the Dodgers' awful postseason pitching. It's completely illogical. There's nothing there. Inflation is always and everywhere a monetary phenomenon. Simple as that. It is caused by the money you printed. And oh, by the way, it's burning off. I mean, not completely. I get it. Consumer demand is going to remain hot. There's still excess money out there. We still have too much wealth. And that all says inflation's running hot. But it's cooling off. We're starting to catch up. Prices are re-equilibrating the money supply with the size of the economy. It's not expectations. But it doesn't matter what I say. It's what he thinks. This is the Federal Reserve narrative. This is what, as far as I can tell, Jerome Powell thinks. A, U.S. inflation was caused by an exogenous shock. It wasn't caused by money supply. It was caused by the war in Ukraine. It was caused by who knows what, right? But now the exogenous shock is here. It is now being driven by expectations. Ergo, it has to keep going. Third thing he thinks is inflation is terrible for American households. Again, how can you look at the data and think that? But that's in his head. It's a terrible scourge. Ergo, you have to stop inflation in its track before it becomes a bigger problem. And yeah, if you cause a recession in the short run, well, it just needs to be done. This is what he's thinking. We have got to get inflation behind us. I wish there was a painless way to do it. There isn't. I get to see my dad with a belt in his hand. Son, this is going to hurt me more than it's going to hurt you. No, it's not. So what are they doing? Well, obviously they cranked up the federal funds rate, but that's not the action. That's not the information. That's not where you need to be looking. That is a red herring. It's a distraction. The real action is quantitative tightening. This is the Fed balance sheet. This is assets on the book. They started with about $4 trillion in assets. That goes back to Bernanke's legacy. $5 trillion in quantitative easing. And now, over the last year or so, they've gotten rid of a little less than $1 trillion of that in terms of quantitative tightening. Remember, quantitative easing, you print the money, buy government debt. Quantitative tightening is where you sell that debt, take money for it, and destroy it. Get rid of it, okay? That is quantitative tightening. Why does this matter? Well, go back to Silicon Valley Bank and First Republic Bank. 2 big bank failures right here in West Bay. What happened and why? Well, the standard story that the newspapers immediately went to, see a couple failed banks, and they immediately start pulling out their list. Oh, those bankers, they're up to their hijinks again, those silly kids. What kind of underwriting games are they playing this time? Who are they foisting their greed upon? We all heard about it, savingsandloan.com. We know these guys. But before you go there, keep in mind that commercial bank loan performance, this is delinquency and charge-off rates, they've never been lower. This is one of the cleanest portfolios in the banking system we've ever seen. There's no debt problems in the American banking system. Well, why did they fail? Well, let's talk about the relationship between money supply and bank deposits. This is where all the action is. $5 trillion of quantitative easing, brand new cash being produced. No matter what you do with that cash, no matter what Congress, wherever they fire hose it, I don't care if they gave it to a low-income family, a business owner, an airport, a logistics company, a healthcare hospital or something. I don't care what they did with the money. Where did it end up? In a bank. $5 trillion of brand new cash turned into $5 trillion of brand new bank deposits. Okay, so what's the problem? Well, let's understand what happened. Take Silicon Valley Bank. Their deposits went from $80 billion to $180 billion in about a year. 80 to 180 billion. So you got $100 billion in extra money. What do you do with it? You do with it exactly what the Federal Reserve tells you to do with it. First of all, you try to make loans. And if you can't make the loans, then you go out and you buy super safe securities called treasuries and GSEs. Okay? So you buy all that good, safe stuff. It is safe. In fact, the only thing that could possibly happen to the value of a U.S. Treasury would be if, I don't know, interest rates suddenly went up suddenly. Well, we'll say for just an example, if the federal funds rate went from 0% to 5%, and as a result of that, the 10-year bond went from 1% to 5%. Now, what is 1% to 5%? What does that mean to the value of a 10-year bond? Well, it reduces the value of it by about 45%. So first, you fill up the banks full of cash, you make them buy treasuries, then you reduce the value of the treasuries by, of course, cranking up the interest rate. Now, even here, you haven't fully pulled it off. You haven't quite gotten to the net result yet, because guess what? Banks don't have to mark to market. They don't have to mark the price of that asset to what it's actually worth in the open market. The only time you have to market is if you would have to sell that asset. Well, why would you have to sell that asset? Well, imagine after cranking up the interest rates, the Federal Reserve suddenly engages in quantitative tightening, causing the deposit base to start contracting. Now money's flowing out of the banking system, and the only way you backfill is by selling assets. So think of that. This was one of the greatest sucker punches on the banking system ever perpetuated by the Federal Reserve. Fill them up with assets, force the value of those assets down, and then force them to sell the assets at a loss. That is what happened to Silicon Valley Bank. Unbelievable. And they continue to do it, and look what's happening. And to be clear, this is not normal for the banking system. The last time we saw declines in deposits in the American banking system, World War II. It's getting destroyed. Remember, the Federal Reserve is selling assets off their books. They get paid for it. They take the cash and they destroy it. So the money supply is shrinking. Deposit base is shrinking. That is the problem. So they continue to do that. Suddenly, loans are no longer growing. The cost of loans, not only are they going up because of federal fund rate, but they're going up because the banks have to crank up their lending rates even above the cost of their funds. Suddenly, it's very difficult to get cash from banks. Mortgage rates are now going through the roof. Well, this is all being driven by lack of credit, by a lack of cash. I guarantee everybody in this room, you're going to walk into a bank over the course of the next year, and you're going to say, I need a loan, and the banker's going to look right at you, look right in the eye and go, no. Don't take it personally. It's not you. It's not that they don't think you can pay them back. They know you can pay them back. They don't have the money to give you. It's as simple as that. Now, the Fed's job is price stability, full employment, and taking care of the banking system, keep the banking system stable. That is their three jobs. They're not necessarily aligned. You got to be careful what you do, because if you do too much of one, you can screw up another. This is why we need people who know what they're doing running the Federal Reserve, which is exactly what's happening now. I mean, think of this. In a preposterous panic over full employment, they blew up price stability. Now, in a preposterous panic over price stability, they're screwing up the credit system. This is what's happening to our economy. And when the Federal Reserve said, I should say, Barr said, Silicon Valley Bank is a textbook case of mismanagement. No, they're not. The Federal Reserve is a textbook case of mismanagement. And this is what should scare everybody. And by the way, this is why you see venture capital falling. It's not because people don't think there's investments to be made here. There's just not that much loose cash out there anymore. It's as simple as that. Now again, is this that big of a deal? No, the unemployment rate's here at 3%. Your tech sector's doing fine. The biggest problem is your tech sector can't expand because they can't have enough people to hire. But nevertheless, obviously, it's an issue for entrepreneurs in this area. And even as all this is going on with the Federal Reserve, you have the federal government continuing to step on the gas. Federal Reserve is on the brake, federal government's on the gas. $1.7 trillion deficit. We have an enormous spending problem on our hands. They just love spending money. Now, how far can this go? I don't know. We have a 120% debt to GDP ratio, one of the highest ever. But that's not that big of a deal. It really isn't. You know, we had 120% debt to GDP at the end of World War II, and within a decade, we halved it. That's not the issue. The issue is we're not talking about it. The issue is it's going to get worse if for no other reason other than the skyrocketing cost of carrying that debt. 2 years ago, it was $500 billion. This last year we just finished, over $700 trillion. The next fiscal year will be over $1 trillion. The year after that, the way we're going, $1.3 trillion. All by itself, that's going to make the problem worse. When does it end? How far can it go? I honestly don't know. In part because it's a conversation first about the narrative and then about the response. One of the things I want you all to keep in mind is Greece did not default on its debt because they couldn't pay off the debt. It's because they refused to pay off the debt. They wouldn't take the political steps necessary to do that. It was a political choice. Where does this go? How far does it go? What choice will we make? No one knows that. What I do know is it's not sustainable. And we all have to watch that. We simply do. So, are we out of the woods? We were never in the woods. We were never in the woods, as simple as that. However, with all that being said, last year, I told you things were fine, don't even worry about it. This year, the headwinds are starting to blow. It's pretty clear. Inflation is going to stay above target because, of course, of the strong consumer, which means the Fed's going to continue to tighten, which is going to continue to hit credit-sensitive industries, particularly real estate. You have these deficit challenges at every level of government, in the state and at the federal level. There's got to be some drag as that starts to clear up. Asset prices are too high, and they will probably start to sag again with rising interest rates. So yes, economic growth should slow pretty sharply over the next year. I don't think we're going to have a recession. In fact, my prediction is they will continue to tighten till roughly spring of next year, maybe early spring. And that's when things will slow down enough and they'll back off. And if you want a conspiracy theory, if he's just doing whatever the boss his current boss is telling him to do, it's exactly what you want to do. You want to crank down, make everybody feel terrible till about April or May next year, and then you take your foot off the brake, let the economy take off, and it's clear sailing into the election. But the bigger issue, of course, are social narratives. So maybe forecast highlights next year, we're looking for about 1.8% growth, unemployment rate staying before 4%, but we're looking for continued increases. We're looking at 10-year Treasury at 5.5. That may get closer to 6. Mortgage rates at 8.5, maybe closer to 9. I think home prices are going to swoon again, but starts are going to stay steady, largely, of course, because of the steady economy. So a whole other interest rate hit coming. Real estate is going to feel the pinch, but consumers are not, which is exactly why the Federal Reserve is going to keep its foot on the brake. But again, the bigger issue, social narratives. There's one other thing I want to bring up here, and I think it's important for us to realize. One of the reasons that narratives are so powerful is that narratives aren't just a function of us being lazy. Narratives also play a fundamental role in how we bond as human beings. We are enormously social creatures. Jonathan Haidt, a great writer, says that human beings are 90% primate, 10% bee. And that 10% bee is a modern sort of changes in how we operate, how we think, how we interact that allow us to be in these incredibly complex social communities like no other primate can. Well, in the midst of that, what keeps us together as bees, it's narratives, it's stories, right? It's all about, what particular God we're all praying to, or what team we're rooting for, or what state we live in. We all have a reason, we all have stories that we use to bond to the people around us. And that's the really scary thing. When these narratives become part of our social bonding, it becomes very hard to break us out of that. People can believe, this is Jonathan Haidt, people can believe pretty much whatever they want to believe about moral and political issues as long as some other people near them believe it. So you have to focus on indirect methods to change what people want to believe. And that is really, really true. There was a point in time where somehow or other I thought I would go into Sacramento and I'd show them a couple graphs in a regression. They'd be like, oh, Chris, silly us. And of course, it didn't happen. In fact, go to the next step on that. I showed you that income inequality is falling. I showed you wealth inequality is falling. By the way, people on the left should be celebrating this. They're worried about income inequality. They're worried about wealth inequality. Ergo, when they see the fact that the tide is turning and things are starting to shift, you would think people on the left would celebrate that. They don't. In fact, they get angry with me when I bring it up. That's one of the weirdest things I've ever encountered. Here is a basic bit of news that should make people feel happier, and it upsets them. Well, again, understand, their common bond is wrapped around this idea that we live in a world of monstrous inequality that's growing day by day. And if you tell them that story is not true, then somehow or other you diminish their capacity to bond within their social settings. This is who we are. So remember, what does this all mean? Well, one of the things is, that was Brad with the Democratic weather. Now here's Tammy with the Republican weather, right? You can see how these things pull us apart. Look, it's easier to fool people than it is to convince them they have been fooled, because once it becomes part of our social bondings, then it becomes so hard to get out of this. And that is the real fundamental place that we have these problems. So as always, at the end of these talks, I tell you to go out and avoid those weapons of mass distraction. Ignore the screaming headlines, the doomsday scenarios. Understand there are pressures, but they're typically not the pressures that you hear about in the news. It's a different kind of story that's out there. And with that, QR code.